This is not just a short-selling move, it's a global capital conspiracy. India's richest man, Gautam Adani, saw his fortune shrink by a staggering $58 billion overnight. Once the wealthiest man in Asia, he has now become a prime target of financial markets. The Indian stock market is in turmoil, foreign investors are pulling out at an alarming rate, and financial experts warn that India's economy could be set back by 20 years. Wall Street's ultimate short-selling playbook is unfolding before our eyes, pushing up the market first, then engineering a collapse, and finally cashing in on the downfall of India's economy. This isn't the first time. In 1997, the Asian financial crisis. In 2008, the global subprime crisis. Now, India is the latest target in this series of financial assaults. So why is Wall Street shorting India? Is Adani really at fault? Will India withstand the pressure? Today, we're going to break down one of the most shocking short-selling cases in history and expose the hidden forces at play. Let's dive in. Part 1. Gautam Adani. From the world's second richest man to Wall Street's target. Adani Group is one of India's largest private enterprises, controlling several of the country's key industries. Energy monopoly. The largest supplier of coal, natural gas, and electricity in India, directly affecting national power security. Port domination. Owns India's largest port network, handling about 30% of the country's maritime trade. Defense and military contracts, supplies defense equipment to the Indian government. Infrastructure giant. Controls airports, railways, and toll roads across India. Simply put, Adani is India's equivalent of Samsung, National Grid, Lockheed Martin, and Elon Musk, combined into one. Half of India's economic infrastructure is under his control. So shorting Adani is essentially shorting India itself. Part 2. How a Wall Street report wiped out $58 billion from Adani's fortune. In January 2023, American short seller firm Hindenburg Research published a 106-page report accusing Adani Group of financial fraud. The report exposed 6 major allegations against Adani Group. 1. Stock manipulation. Used offshore shell companies controlled by his family to artificially inflate stock prices. 2. Hidden debt. Concealed $32 billion in liabilities through a complex financial structure. 3. Fraudulent financial reporting, falsified revenues, and exaggerated profits to mislead investors. 4. Money laundering. Used offshore companies in Dubai and Singapore to clean illicit funds. 5. Draining India's economy. Leveraged government connections to receive massive subsidies while crushing domestic competition. 6. Collusion with the Indian government. Prime Minister Narendra Modi has long supported Adani, raising concerns about insider deals. As soon as this report was released, Adani Group's stock price plummeted, wiping out $108 billion in market value. Overnight, Gautam Adani's personal fortune shrank by $58 billion. Part 3. This isn't the first time. India has been a Wall Street target before. In 2013, the U.S. Federal Reserve hinted at tightening monetary policy, signaling the end of cheap money. This led to a massive exodus of foreign capital from emerging markets. The Indian rupee crashed by 20% in just a few months, reaching a historic low. Here was the Wall Street's playbook. 1. Flood India with low-interest foreign capital, creating an illusion of rapid economic growth. 2. Trigger an outflow of money by raising interest rates in the U.S., causing the rupee to crash. 3. Foreign investors swoop in at rock-bottom prices, while Indian businesses and retail investors suffer heavy losses. And the outcome was, India suffered a severe financial setback, entered a bear market, and had to seek assistance from the International Monetary Fund. Another case was in 2008. When the 2008 subprime mortgage crisis hit the U.S., investors rushed to liquidate emerging market assets and move money back to safer U.S. markets. As a result, India's stock market collapsed by 60%. Foreign investors withdrew billions, and Indian companies faced a credit crunch. Here was the Wall Street's playbook. 1. Pump billions into India's stock market during periods of low interest rates. 2. Withdraw funds when the U.S. economy weakens, triggering a market collapse. 3. Buy back Indian assets at heavily discounted prices, exploiting the crisis. Then India plunged into recession, unemployment surged, and IMF intervention was required. Part 4. In 2025, is India still under attack? As we step into 2025, the aftershocks of Wall Street's attack on India are still reverberating through the economy. The financial markets are far from stable, and the battle between global capital, short sellers, and Indian regulators is heating up. Wall Street isn't done yet. In fact, the next phase of the financial assault is already taking shape. Here are the prediction of 5 biggest risks facing India's economy in 2025 and how they relate to short selling. 1. The Adani short-selling fallout isn't over. New targets are emerging. After the Hindenburg attack on Adani in 2023, investor confidence in India's corporate governance remains fragile. Short sellers aren't stopping with Adani. Other major Indian conglomerates, Reliance Industries, Tata Group, and HDFC Bank, are now rumored to be under increased scrutiny by hedge funds. If another major financial scandal emerges, Wall Street could use it to trigger another market panic and execute a fresh wave of short positions. Short sellers will expand their attack beyond Adani, looking for the next over-leveraged Indian company to target. 2. Foreign capital outflows are accelerating, strengthening Wall Street's attack. Since Q4 2024, foreign institutional investors, FIIs, have pulled over $80 billion from Indian markets, one of the largest capital flights in Indian history. With the U.S. Federal Reserve maintaining high interest rates, global investors are shifting money away from India and back into safer U.S. assets. Short sellers are capitalizing on this. They understand that when liquidity leaves a market, stocks become more vulnerable to sharp sell-offs. Leverage capital outflows to intensify short-selling pressure, forcing the Indian market into deeper correction territory. 3. The Indian rupee faces a possible currency crisis, a classic short-seller strategy. Since mid-2024, the Indian rupee has depreciated over 9% against the US dollar, marking its steepest decline in years. Currency devaluation is a favorite tactic for financial attacks. Wall Street hedge funds could short the rupee, profiting from the instability. If a currency crisis escalates, India could be forced to use foreign reserves to stabilize the rupee, restrict capital movement, or even seek emergency IMF assistance, all of which would damage investor confidence further. Short sellers will target both Indian equities and the rupee, making it harder for the central bank to stabilize the situation. 4. Inflation, food prices, and public unrest. A perfect storm for market manipulation. Inflation remains above 7%, driven by rising food and energy costs. A weakening rupee will make imports more expensive, worsening inflation. Wall Street firms could exploit social instability by shorting retail and consumer goods sectors, predicting a drop in domestic consumption. Short sellers will identify struggling consumer-focused sectors, retail, FMCG, e-commerce, and place strategic bets on their decline, worsening economic sentiment. 5. The Indian stock market is overvalued, a perfect setup for a short squeeze. The Nifty 50 index surged by over 18% in 2024, fueled by domestic investor optimism despite rising global risks. However, many Indian stocks are now trading at historically high valuations, making them prime targets for short sellers looking to force a correction. If investors panic and start selling, the market could enter a self-reinforcing downward spiral, allowing Wall Street to cash in on massive short positions. Hedge funds will coordinate media narratives to trigger investor panic, intensify the sell-off, and profit from their shorts before covering at lower prices. Part 5, 2025 Forecast. How will this battle unfold? With India caught in the crossfire of global finance, 3 possible scenarios could play out in 2025. 1. India defends against Wall Street. The Indian government steps in aggressively, implementing capital controls, increasing liquidity injections, and stabilizing the rupee. Foreign investors return, confidence is restored, and the stock market stabilizes. Wall Street's short sellers fail to create lasting damage. Scenario 2. The market undergoes a deep correction. The Nifty 50 index drops 20–30%, correcting from overvalued levels. Indian institutions try to absorb the sell-off, but foreign capital continues exiting the market. Hedge funds profit from their short positions, then slowly start buying back at lower levels. India avoids a full-blown crisis, but 2025 remains a year of volatility. Scenario 3. Wall Street fully collapses India's market. A second major corporate scandal emerges, another Adani-level case, triggering full-scale panic. The rupee crisis spirals out of control, forcing India into emergency economic measures. The stock market crashes over 40%, wiping out years of growth. Wall Street hedge funds execute one of the largest financial extractions from an emerging market in history. If India fails to defend its markets, it could face a 1997-style financial crisis, setting the economy back by a decade or more. The battle for India's financial future is happening now. The question is, who will win? What do you think? Drop your thoughts in the comments, and see you in the next video.